It feels like World War III is about to start, and yet Wall Street is not even flinching. What is going on? Why are some investors so calm? And how long is this going to last? I'm excited to talk to you today about everything you need to know about the effects that war has on the economy, on the share market, and what you need to do to make sure that you are taking care of your finances in a very, very, very uncertain time. You wouldn't be wrong to think that war itself has a very negative effect on the economy of any country that is involved, and you would be absolutely correct. In a study that looked over 150 wars from 1870 till now, they found that the cost of war is highest in the country that has been affected. And this kind of makes sense. I mean, buildings are destroyed, machinery is destroyed, infrastructure is destroyed, and it takes years and years and years and lots of capital to build this back up. Not to mention a lot of costs that people don't think about, like the increase in debt or the psychological costs of the war, or also opportunity costs. People are focused on surviving instead of creating innovation. And also surrounding countries, the neighbors of war as they're called, end up having quite a significant loss as well. They also have buildings destroyed. They also have a loss of labor. And not to mention, often they are taking on the burden of hosting, caring for, and relocating refugees that have come from war. Probably one of the most recent examples of this is what we're seeing happening in Ukraine, where there is an expectation that about $120 billion worth of GDP will be lost and over $1 trillion in stocks will be lost by the year 2026 because of Russia's invasion into Ukraine. And in terms of Iran becoming a war site, if this goes ahead, the cost it would have on the global economy over a 5-year period is estimated to be over 1.7 trillion, not billion, trillion dollars. That's a lot of money. And also, war can lead to inflation. A good example of this was seen during the American Civil War, where the Confederacy ran out of money, they got into a lot of debt, and they did not have cash to pay their soldiers. So what did they do? Well, they simply printed more money, which have resulted in a lot of cash, but the loss of value of cash, and ended up leaving a lot of middle-class Americans in unfortunate amounts of debt. It was a horrible, horrible outcome. So then you might be wondering, well, Sim, why is the economy doing so poorly, but shares aren't tanking? What's going on? And the best way to explain this is that the share market is independent from the economy. Let me say this again. The share market is independent from the economy. I often like to say the share market and the economy, they're kind of like cousins. They're similar, but they're not completely identical, and they often lead very different lives. You can have times where shares do really, really well and the share market is soaring. Meanwhile, the economy is absolutely bust. Employment rates are very low. Inflation is high. People are stagnant and are not spending. Consumer discretionary spending drops. And an example of this would probably be during COVID. We saw everyone being really, really worried about their finances. Economies tanked. Some recessions even occurred. And yet the share market had one of its most amazing and most fastest bull runs that it had had in a very long time. And you might be thinking to yourself, well, Sim, I thought that the share market didn't like uncertainty. And what's more uncertain than war? War brings a lot of uncertainty, right? And to be honest, I completely agree. I have 2 theories on why this is happening. The first is that maybe people don't think that Trump is as unstable as he appears. After all, he was going back and forth on the whole tariffs idea. He would keep extending the tariff deadlines. And I have a feeling that maybe a lot of retail and institutional investors are kind of calling bluff on his idea that he will go ahead and push for World War III. And the second theory is that people already price in the fact that there may be a war. So the share market is not going to have a dramatic reaction based on something that has already kind of been considered as a possibility, especially when tensions globally in many different countries have been brewing for quite a long time. But I didn't want to just rely on my theories alone, so I looked at a study titled The War and Economic Growth, and I found something quite interesting. They looked at the impact of war on capital stock and population and found that war only has a transient effect on a long-run equilibrium. What that means in simple terms is they don't believe that war has a long-term effect on the share market, even though it might have an effect on the economy. And this was backed up by an article called Counterintuitive Market Movements by Ben Carlson, the director of institutional asset management. And he said that from the start of World War II in 1939 to the end in late 1945, the Dow was up a total of 50%, more than 7% per year. So during two of the worst wars in modern history, the US stock market was up a combined 115%. Let me say that part again. During the two of the worst world wars in modern history, the US stock market was up a combined 115%. He then went on to say that the relationship between geopolitical crises and market outcomes isn't as simple as it seems, which is kind of an understatement. But I appreciate what he's trying to say. It is not a direct correlation between a market drop and a war. And oftentimes, even though we might see a correlation between war and the economy, the share market and the economy are loosely related. Remember, cousins. And if that, distant cousins. And when you look at market shock events like when North Korea invaded South Korea or like Pearl Harbor, the average drawdown of the share market in one single day was 1.2%. And the total drawdown across all these geopolitical shock events was only 5%, a 5% loss of the S&P 500. And the highest drop across all of them was only 11.6%, and that was after 9/11. And in terms of recovery, it only took an average of 47 days for the market to recover. And it kind of feels dystopian to say that here's another example of a more recent war that we have where we can see these numbers. But when we look at when Ukraine was attacked by Russia, the market did drop in 2022, down 7%, but it was back up and doing better than expected within a single month. When I started seeing the global political tensions rising, especially in Israel and Iran, and then also seeing the impact that the United States was having, I was very worried about the people, the welfare of citizens, very worried about the economy of these places and neighboring countries, but I wasn't too worried about the impact it would have on the share market. And that's because I understood this idea of the war puzzle. Basically, in 2015, the Swiss Financial Institute figured out a way to describe that sometimes when war happens, the market reacts in usually one of two ways. If the war is something that is predictable, we've spoken about this on a previous episode, I think 1 or 2 years ago. If it is a predicted war, we see tensions brewing and it's slowly happening over time. Usually the market actually sees a spike and then it returns down to baseline. On the other hand, if a war is unprecedented and happens very quickly, all of a sudden out of the blue, a little bit like Ukraine, we see the market dip temporarily and then it comes back to baseline. And if that's not enough reason to not worry, let me give you some more stats. During the First World War, the share market did drop 30%. The share market was then closed for 6 months. And then when it reopened, it bounced back up by 88%. That is a huge rise. And during World War II, when Hitler invaded Poland in 1939, the share market actually rose, which is insane. And from 1939 to the end of World War II, the Dow actually increased by 50%. So what should you be doing as an investor? Well, it's super, super clear. There are 3 things that I am doing during this time. The first is staying informed and not being reactive. I am reading the news. I am checking the share market. I am looking at everything, but I am not looking at it to change my investment style. The second thing you want to do is differentiate the share market from the economy, because not all macro risks are going to correlate in corporate declines in profits or earnings. And number 3, stick to long-term investing. The markets have seen more wars than we have in our own lifetime. And if you're investing in broad market index funds, you will see that long-term investing always outperforms emotional decision-making. Tensions may worsen, oil prices may spike, inflation might be making a resurgence. And at the end of the day, the fundamentals have not changed. Panicking is not a strategy. Staying calm is. I hope you found this episode helpful, and if there is anything that you have been able to find useful, then please, all I ask is take a screenshot of this episode, put it on your Instagram story, tag friends that invest, and please, please, please give us a subscribe on YouTube. And with that, I'll see you next week.